Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steven Ehrlich, director of research at Digital Assets with Forbes Crypto, to discuss Bitcoin and Ethereum, how they're soaring year to date, and what is behind the surge. Steven, it's great to see you as always. Welcome back to Trade Talks.
Great. Thanks, Jill. Thanks for having me again.
You got it. What's so interesting is this surge coincides with the news that Genesis Digital Trading, DCG's lending desk, recently filed for bankruptcy. Why did the market not react negatively?
Yeah, I think this is an interesting test of what some people call the efficient market hypothesis, which is basically the idea that certain types of news events are priced into, are disseminated widely and priced into the current markers for different assets. In this case, I think that, I mean, the Genesis troubles had been tracked for months, ever since the collapse of Terra Luna, the Three Arrows Capital back last spring, last summer, and especially much more acutely over the last couple of weeks, where I think it was kind of preordained that Genesis was going to have to file bankruptcy. And so when that actually happened, I think the markets were kind of expecting it, and they yawned a little bit. I also think that there is a bit of calm coming from the fact that it is owned by Digital Currency Group, run by Barry Silbert, which is one of the largest and most important companies in the entire ecosystem. And while Barry may have to make some difficult decisions as far as, is he going to trade off or sell off some of his large portfolio companies? Is he going to have to do something with Grayscale, which operates their digital asset funds, the closed-end funds, or sell CoinDesk, the news site that they own? Barry may have to make some difficult decisions, but I get the sense that there's some optimism that, unlike other bankruptcies, Genesis will be able to pull itself out of this quicker than most as well.
What advice would you give to crypto investors trying to make sense of all this?
Yeah, that's a really good question, because it's really hard. The first thing I would say is it's very hard to time the market. Some folks that may have bought in, especially over the last couple of months when the market was really at its bottom, where it was pressing like 15,000, 16,000, and now look, you're up, I don't somewhere around 50%. I mean, that's a pretty good gain. That said, so it's perfectly reasonable if you want to take off some of the profits. I would expect a bit of a drop still, though, because I believe a reason behind a lot of this surge, Bitcoin's up about 35%, Ether's up 30% year to date, and even some of the crypto stocks that got pummeled last year, like MicroStrategy, Coinbase, and Bitcoin mining stocks, are up 20 to 50%. I think a big reason for this is because folks are getting encouraged by dropping inflation numbers, although they're still high, obviously, from historical levels, increasing layoffs, especially in the tech sector, and a growing belief that the Fed's only going to raise rates by 25 bips at its next meeting in February. And all that combines into I guess, a feeling that perhaps the Fed's going to be able to navigate a smooth landing for this economy after all. I'm not entirely convinced of that. It's hard to put into perspective how much money, trillions of dollars, was injected into the global economy as a result of the COVID pandemic, and I don't necessarily think that all the pain is over quite yet. So what I would say is, if you want to take off some profits, if you're sitting on some short-term gains, I think that's fine. But at the end of the day, what I typically advise my readers and basically anyone investing in crypto is that it's a long-term game. So does it really matter if you sell at 15, 17, 23? Most people that I know investing are hoping that's going to go up into back into like the 50s, 70s, 100,000, 200,000 in 7 to 10 years. So just keep that in mind as well.
Yeah, well, I mean, it's kind of what's happening in the equity market as well. The Fed is saying one thing, it hasn't changed its policy path, and the market just wants to believe something else, and it feels as if that's what's happening in the crypto market. And you would hope that at some point it would start to decouple from what we're seeing in the macro narrative. But, to your point, this is a longer term game. Let's talk about Binance. That's been getting into trouble recently, how it collateralizes certain tokens that it issues into Binance Smart Chain and other blockchains. What does all this mean, and why does it matter?
I'm glad you brought this up, because it is an important question, and it's a little complicated, so I'm happy to kind of explain it. Most tokens, stable coins, or even assets like Bitcoin, exist on multiple blockchains. That's not necessarily something that everybody knows. That doesn't happen through magic. Usually what needs to occur is that there has to be some sort of like connectivity software. It's typically called a bridge in crypto parlance, where you lock up a token in kind of a smart contract, some sort of vault where there's a certain number of signers that have the ability to move tokens, and then you issue a back token, typically 1-to-1, onto another blockchain. Binance has a stablecoin called BUSD. It's the third largest stablecoin by market cap, with a market cap of about $15 billion. It's issued by Paxos, which is a regulated company here in New York. However, Paxos only issues BUSD on Ethereum. Binance, obviously, its CEO Changpeng Zhao is closely associated with Binance Smart Chain and Avalanche and some other blockchains, and they want to get that stablecoin because it's an important source of liquidity and it's attractive for users onto these other blockchains. Well, since Paxos won't do it, what they actually have to do is they need to take these BUSDs, lock them up in a smart contract, and then they issue what's called like a Binance pegged coin, or basically their version of like a stable coin, but instead of being backed by $1 in a bank, it's backed by a BUSD, which then is backed by $1 in a bank. I know this is a little bit complicated, but what ends up happening, and some research that came out in the last couple of weeks showed, is that Binance did not necessarily do a good job with its accounting, and there were multiple periods of time where its Binance pegged stablecoin on these other blockchains was under collateralized by more than $1 billion. This means that if at one point in time every single person that owned one of those tokens tried to redeem it, there would not be enough money. And in stable coins, that's just not something that should ever happen. And then it was just released, I guess, a day or two ago, that Binance does this with multiple, almost 100 tokens, not just the stablecoin, and they were co-locating those assets with customer funds and trading funds, which obviously is an accounting nightmare. And given what's happened with FTX and just a general focus on the lack of proper accounting and auditing standards on crypto exchanges around the world, this is a major problem.
Yeah, I mean, Stephen, as you're telling me this, I'm like, this sounds just like FTX. How have we not learned any lessons here when it comes to commingling and improper accounting methods? I mean, and my second question to you is, who sets the value of these assets? Oh, it's worth $5? You know, how are these values being set?
Right. I mean, they're free floating assets, so the values can change even for stable coins. If you look closely, sometimes they'll be 98 cents or 99.3 cents, or sometimes they'll actually go above $1 if there's a period of market panic and investors rush into stable coins because they see them as a safer alternative to some of these free floating assets. But I mean, I think what your question is getting at, Jill, is that these assets really should maintain parity with the underlying collateral at almost all times. And that's not necessarily true. Sometimes there are legitimate fluctuations due to market dynamics, but you can see big outsized fluctuations if there's reason to suspect that the fidelity or the constitution of the reserves backing one of these assets comes into question.
Okay, appreciate that clarification. There was some news this morning that decentralized crypto derivatives exchange is pushing back a 9-figure token unlock from February to the end of the year. What are token unlocks, and how do they usually impact crypto prices?
Right. So this is another interesting question too. When a venture capital firm buys a stake in a company, be it an infrastructure firm, a crypto exchange, some NFT gaming company, there's a couple of options. One, they could actually get equity, private shares that then stay private until there's some sort of liquidity event like a takeover, or more commonly an IPO. Or in crypto, because of how they sort of created tokens, they can get tokens. Most of these tokens are free floating. They trade 24/7, 365. But for investors, and also to kind of, I guess, try to protect retail investors, they'll usually purchase these tokens with lockup periods. For instance, a 4-year vesting period where tokens unlock 25% each year, just as an example. These can be pretty seismic events because oftentimes there's a very big difference between the free floating amount of tokens out there, the stuff that is available for anyone to trade, and the fully diluted amount, which would be the market capitalization if every token was suddenly put onto the market. These can be nine-figure type liquidity events, and they're all public, and it's easy for people to watch. And there's fear that when these tokens get dumped onto retail investors, that it could lead to a big price drop because all of a sudden there's a huge surge in the amount of assets that can be purchased. One of the trends, I think CoinDesk actually did some great research on this, that they found is that a lot of projects actually try to coincide, because they know that these can be negative price events for these assets. They actually try to coincide good news, like an investor or some new partnership, to drop right around the time of the token to help support the price. DYDX, we don't know exactly the reason why, but it's being reported that they pushed back this token unlock, which would have been about a 9-figure unlock from February to December. And maybe that has to do with the pressure that's been coming onto these projects with the unlocks. I mean, maybe it has something to do with just how the project's being developed. But these token unlocks, They raised some real, I think there's legitimate reasons for them to exist, especially if projects want to sell tokens and not equity to investors. But at the same time, there is real risk of customer harm if they're not handled appropriately. And I think that's what this recent news and some of the other token unlock stories that have come out recently are really getting at.
All right, Stephen, appreciate you breaking it down for us as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.